Mayuresh Joshi from Angel Broking as well joins in with his take on the market. Mayuresh, hi, morning. Just debating as to, the macro environment now getting a little challenging. The bond yields are already reflective of that fear as well. We've just seen the trade deficit data, which has come at a 3-year low too, or rather 3-year high, I beg your pardon. Do you sense that all these factors put together, we may see some more downside in the market in the near term?
Morning, Ayesha. Yes, I think that remains a possibility, but as Sandeep was mentioning, I think it's getting a little bit stretched in terms of what the market is probably tethering at this point of time. So crude oil prices, totally agree. I think was reading a report late night yesterday with shale supplies actually increasing. The IEA has actually cut down the demand forecasts. So not expecting a huge spike up in terms of crude prices. In fact, they might actually correct, as Sandeep was mentioning. So that might put a huge amount of relief for an economy like ours. What the market is hinging on at this point of time, apart from what will happen on the Gujarat elections, is obviously going to be corporate earnings, and corporate earnings are seemingly looking that they will recover in Q3 and Q4. So if one goes by the premise of a 13-14% earnings growth, I think the markets will take solace from that fact, and you might probably just see the markets reverting back to their mean in terms of the positive divergence that we've seen. So a correction not ruled out, but I don't see a huge correction onto the markets. The private capex cycle is delayed, and that might still take a few quarters to recover. But a large element of the market is that the corporate earnings will revive, and I hope that they do in the second half. So not a big correction. I think any correction should be seen as a good buying opportunity in qualitative stocks.
And Mayuresh, you may want to jump in on this one. There's nothing exceptionally wrong with Eicher Motor numbers, but the fact that Eicher Motor is now a stock which is at a P of 45.50, the company is giving you a projected return of 25%. And Mayuresh, at a time when the market style is changing, which is that laggards and the value stocks are making a comeback, do you think some of these haloed expensive stocks could take a backseat? I mean, these companies will grow, but the stocks may not move.
It is a possibility, Nikunj, and look at the base that Eicher has created for itself. Now, if one really assumes that they carry on this performance repeatedly and outbeat analyst expectations, I think it's a little bit too much in terms of what the company can deliver. Nothing taking it away. I think if you look at the kind of numbers that they've delivered, 202,000 odd bikes that they've sold, the highest ever. Again, the margins at 31.9%, very, very impressive considering the base that they are working on. And the management has made it very clear, even in this fiscal, they are probably planning to sell 8,25,000 bikes. Even on the commercial side of the business, you're probably seeing overall the industry patterns where discounting is coming down, and you're probably seeing all the effects of BS4, GST probably getting weared out. And as this volume growth starts picking up, you're probably going to see some amount of margin stability on that front. So valuations have been expensive at Eicher. They always will remain expensive. So largely, I think the whole recommendation continues. But yes, I think from the larger pockets, I think there are still decent stocks that can be looked at from a bottom-up approach.
Mayuresh, come to you, and two stocks that you like, Amara, which came out with a good operating level performance this quarter around, and then Sri Pushkar.
Morning, Tanveer. Yes, I think good operating performance by Amara Raja, and it's definitely underperformed the market leader Exide. But again, I think there are significant trend-changing events that are happening. The leadership position that it probably has in the UPS and the telecom segment, I think you're probably going to get more traction out there, and that probably will sustain the industrial part of the growth that the company can deliver. On the automotive part of the business, I think even with lead prices moving up, I think the performance was quite commendable this time round. And when you look at all the capacity expansions that the company is doing, whether it be four-wheelers, two-wheelers, the technological innovation that it brings from its parent Johnson Controls, whether it be extended warranties for batteries or superior quality batteries, all of this is going to aid it in the long run in terms of gaining market share, both on the OEM and the replacement part of the business. So a greater part over the next 2 years will be a 15% earnings growth that can get reflected in numbers. margins should get sustained around that 16% or mark. And we're probably talking about earnings growth as well. I think earnings growth should be around 17-18 odd percent. So yes, I think any decline becomes a very good buying opportunity and staggered way for long-term investor. The other stock from the specialty chemical space, Shri Pushkar, on any significant decline, I think the same logic. The kind of numbers that this company has posted and is expected to post on an historical basis over the last 5 years, it has a revenue growth of 16% on a CAGR basis. The EBITDA has grown at 24 odd percent and the profitability has grown in excess of 43 odd percent. Now it ended the year FY17 with 315 crores of top line. The management expects top line to the tune of 410 crores. So you're definitely going to see improvement in terms of top line. So I think this is a very interesting story happening on the specialty chemical space.
Okay, I'll just come back.
Mayuresh, are you hot in this entire multiplex business? If yes, which way would you lean? Market leader PVR or Inox, which has potential to come back?
So Nikunj, PVR becomes a clear hold. Look at the kind of numbers that it has posted and the expectations, both in terms of footfalls. The average ticket price is way about 200 odd rupees now. You're looking at these spends over and above the ticket prices to actually sustain over 90-95 odd rupees. And the ad revenue growth has also sustained. The consolidation in the industry is pretty obvious at this point of time, with DT cinemas getting consolidated with PVR. The number of screens have exceeded 600 and they're very, very conservative in terms of additions. So I think 50, 60 screens added every year. So I think the kind of capex that one would put in, I think is going to be a little bit on the conservative side. Having said that, I think content and the distribution lineup and the pipeline of movies is something which drives the exhibition business. So I think the pipeline looks pretty strong. So PVR a clear hold. I think from a valuation perspective, Inox is pretty interesting at this point of time. But I think consistent numbers will help the stock getting re-rated.
Okay.
Okay, let me recap all the trading ideas which have been coming in today, and let's start off with